Welcome to Insights and Beyond, where we dive deep into the facts behind the headlines. Today, we're busting some of the most common myths about recessions that you probably believe. We'll reveal what the experts often leave out and equip you with the knowledge to navigate economic downturns with confidence. Stay tuned for a mind-opening journey. Part 1. Understanding recessions. To debunk the myths, we first need to understand what a recession truly is. A recession is typically defined as 2 consecutive quarters of negative GDP growth. However, this definition is simplistic and overlooks many nuances. Myth 1. Recessions are always bad for everyone. Fact. Contrary to popular belief, not everyone suffers during a recession. Certain sectors can thrive. For instance, discount retailers often see a surge in business as consumers seek cheaper alternatives. During the 2008 recession, Walmart's net sales increased by 7.2% as people flocked to save money. Additionally, companies providing essential goods and services often see steady or increased demand. Another sector that can benefit during a recession is the repair and maintenance industry. When people are looking to save money, they often opt to repair items rather than replace them. This can lead to increased business for mechanics, home repair services, and electronic repair shops. For example, during the 2008 recession, auto repair shops saw a noticeable increase in business as people chose to fix their cars rather than buy new ones. The entertainment industry, especially low-cost entertainment options, can also thrive. During the Great Depression, the movie industry saw a boom as people sought an affordable escape from their daily struggles. Similarly, during more recent recessions, streaming services, video games, and other forms of affordable entertainment have seen increased demand. Myth 2. Recessions are predictable. Fact. Even experts can't consistently predict recessions. The Great Recession of 2008 caught many off guard, including prominent economists and financial institutions. According to a study by the IMF, only 11 out of 49 economies experienced a recession that was predicted with accuracy. This shows the inherent unpredictability of economic downturns. The challenge of predicting recessions is compounded by the fact that they can be triggered by a wide range of factors, including financial crises, geopolitical events, natural disasters, and pandemics. For instance, the COVID-19 pandemic led to a sudden and severe global recession that few foresaw. The complexity and interconnectivity of the global economy make it difficult to identify and predict the specific triggers of future recessions. Myth 3. Recessions always follow the same pattern. Fact. No 2 recessions are alike. They vary in duration, severity, and impact on different sectors. The dot-com bubble in 2001 primarily hit tech companies, while the 2008 financial crisis had a more widespread effect. Understanding these differences is crucial for crafting effective responses. For example, the 1990-1991 recession in the United States was relatively short and mild, primarily affecting the real estate and financial sectors. In contrast, the Great Recession of 2008-2009 was longer and more severe, with widespread impacts across multiple industries and countries. The COVID-19 recession had a unique pattern, with a rapid initial decline followed by a gradual and uneven recovery, heavily influenced by public health measures and government interventions. Part 2. Common misconceptions about recession causes. Myth 4. Recessions are caused solely by economic factors. Fact. Recessions can result from a complex interplay of economic, social, and political factors. For example, the COVID-19 pandemic triggered a recession due to a sudden halt in economic activity, not just traditional economic cycles. The IMF estimated a global GDP contraction of 3.5% in 2020, highlighting the multifaceted causes of recessions. Political instability can also contribute to recessions. For instance, the uncertainty and economic disruptions caused by the Brexit vote in 2016 led to a slowdown in the UK economy. Similarly, trade wars and tariffs, such as those between the US and China, can create economic uncertainty and reduce global trade, potentially leading to a recession. Natural disasters and environmental factors can also play a role. Major events like hurricanes, earthquakes, and droughts can disrupt economies, particularly in regions heavily dependent on agriculture or tourism. The economic impact of climate change is an emerging concern, with potential to cause significant economic disruptions in the future. Myth 5. High debt levels always lead to recessions. Fact. While high debt levels can contribute to economic instability, they don't always result in recessions. Japan, for instance, has maintained high debt levels for decades without experiencing a prolonged recession. As of 2021, Japan's debt to GDP ratio was over 250%, yet its economy has shown resilience. The key factor is how debt is managed and the context in which it is accumulated. Countries with strong institutions, diversified economies, and effective monetary policies can manage high debt levels more effectively. Additionally, the purpose of the debt matters. Borrowing to invest in infrastructure, education, and technology can spur economic growth and improve debt sustainability. It's also important to differentiate between public and private debt. While high levels of private debt, particularly in the housing sector, contributed to the 2008 financial crisis, public debt does not always have the same destabilizing effect. Effective government policies and prudent fiscal management can mitigate the risks associated with high public debt. Part 3. The real impact of recessions. Myth 6. Job losses are the worst part of a recession. Fact. While job losses are a significant and immediate impact, the long-term effects on mental health and social stability can be just as damaging. A study by the National Bureau of Economic Research found that the suicide rate increased by 1% for every 1% rise in unemployment during the Great Recession. This highlights the broader societal impacts that are often overlooked. The stress and uncertainty caused by job loss can lead to increased rates of depression, anxiety, and other mental health issues. Families may experience higher levels of conflict, and children can suffer from the instability, potentially affecting their educational and developmental outcomes. Social cohesion can also be strained during recessions. Communities may experience higher crime rates, reduced civic engagement, and increased polarization. The long-term effects on social stability can be profound, making it essential to consider these broader impacts when assessing the true cost of a recession. Myth 7. The stock market is the best indicator of a recession. Fact. The stock market can be a leading indicator, but it doesn't always reflect the broader economy. During the COVID-19 recession, the stock market rebounded quickly due to government stimulus measures, while unemployment rates remained high. According to the US Bureau of Labor Statistics, unemployment peaked at 14.8% in April 2020, even as the S&P 500 recovered much faster. The disconnect between the stock market and the real economy can be attributed to several factors. Large corporations with significant market capitalization can perform well due to their global operations and access to capital, even when smaller businesses and local economies are struggling. Additionally, investor sentiment and speculative behavior can drive stock market movements that are not aligned with economic fundamentals. It's important to look at a range of economic indicators, including employment rates, consumer confidence, business investment, and economic output, to get a more comprehensive picture of the health of the economy during a recession. Part 4. How to navigate a recession. Myth 8. Cutting back on all spending is the best strategy. Fact. While it's wise to be cautious with spending, investing in education or career development during a recession can pay off. According to the Federal Reserve Bank of New York, individuals who pursued higher education during the Great Recession saw better job prospects and higher earnings once the economy recovered. Recessions can be an opportune time to develop new skills or pursue additional qualifications that can enhance your career prospects. Online courses, vocational training, and certifications can provide valuable opportunities for growth. Investing in education can also provide a sense of purpose and direction during uncertain times, improving mental well-being. It's also important to maintain essential spending on health, nutrition, and well-being. Cutting back excessively on these areas can have long-term negative consequences that outweigh short-term savings. Striking a balance between prudent financial management and strategic investments in your future is key to navigating a recession successfully. Myth 9. Only large corporations can survive recessions. Fact. Small businesses can and do survive recessions by adapting quickly. During the 2008 recession, many small businesses thrived by pivoting to online sales or offering new products. A report by the Kaufman Foundation found that over 50% of Fortune 500 companies were started during a recession or bear market, highlighting the potential for innovation and growth. Small businesses have the advantage of being more agile and adaptable than large corporations. They can quickly respond to changing market conditions and customer needs. During the COVID-19 recession, many small businesses successfully shifted to e-commerce, curbside pickup, and delivery services to maintain their operations. Community support and local initiatives can also play a crucial role in helping small businesses survive and thrive during recessions. Shop local campaigns, government grants, and small business loans can provide the necessary resources and support for small businesses to weather economic downturns. Part 5. Recession Recovery Myths. Myth 10. Economies bounce back quickly after a recession. Fact: recovery can be slow and uneven. After the 2008 financial crisis, it took several years for many economies to return to pre-recession levels. According to the World Bank, global GDP growth didn't fully recover until 2010, and some countries experienced prolonged periods of stagnation. The pace of recovery can vary significantly depending on the severity of the recession, the effectiveness of policy responses, and the underlying economic conditions. For example, while the US economy recovered relatively quickly from the COVID-19 recession due to massive fiscal and monetary stimulus, other countries faced more prolonged challenges. Structural issues such as labor market mismatches, reduced business investment, and weakened consumer confidence can prolong the recovery process. It's important to recognize that economic recovery is not a linear process and can involve periods of setbacks and slow progress. Myth 11. Government stimulus always works. Fact: government intervention can help, but it's not a guaranteed solution. The effectiveness of stimulus packages depends on their size, timing, and how they are implemented. For instance, the US government's response to the COVID-19 recession included multiple stimulus packages totaling over $5 trillion, which had varying degrees of impact on different sectors. Targeted and well-designed stimulus measures can provide much-needed support to individuals and businesses, boost demand, and stabilize the economy. However, poorly designed or mistimed interventions can have limited effectiveness or unintended consequences. For example, excessive stimulus can lead to inflationary pressures, while insufficient support can fail to address the root causes of the recession. The effectiveness of government stimulus also depends on the broader economic context and the specific challenges faced by the economy. Policymakers must carefully assess the situation and tailor their responses to achieve the desired outcomes. Part 6. Busting more myths with data. Myth 12. Housing markets always crash during recessions. Fact: while the 2008 recession was marked by a housing market crash, this isn't always the case. During the COVID-19 recession, housing markets in many areas remained robust. According to the National Association of Realtors, US home sales in 2020 reached their highest level since 2006, driven by low interest rates and changing housing needs. The resilience of the housing market during the COVID-19 recession can be attributed to several factors. Low mortgage rates made home ownership more affordable, while remote work and lifestyle changes increased demand for suburban and rural properties. Government policies such as mortgage forbearance programs and eviction moratoriums also provided support to homeowners and renters. The housing market's performance during a recession depends on various factors, including the underlying economic conditions, supply and demand dynamics, and policy responses. It's important to recognize that not all recessions will have the same impact on the housing market. Myth 13. Inflation always rises during recessions. Fact: inflation can actually fall during recessions due to decreased demand. In the Great Recession, the US experienced a period of deflation, with prices falling by 0.4% in 2009. This deflationary trend was also observed in other major economies, highlighting that inflation is not a guaranteed outcome of a recession. During recessions, reduced consumer spending and business investment can lead to lower demand for goods and services, putting downward pressure on prices. Additionally, excess capacity in the economy can contribute to deflationary pressures. Central banks often respond to deflation risks by implementing monetary policies to stimulate demand and prevent a deflationary spiral. The relationship between recessions and inflation is complex and can vary depending on the specific circumstances. While some recessions may lead to inflationary pressures, others may result in deflation or stable prices. Myth 14. Recessions only affect the poor. Fact: while low-income individuals often feel the brunt of a recession, high-income earners are not immune. During the 2008 recession, many high-paying finance and tech jobs were lost. According to the Pew Research Center, the wealthiest 10% of US households saw their net worth decline by 8% between 2007 and 2010. Recessions can have a broad impact across different income groups, affecting job security, investment portfolios, and overall financial stability. High-income individuals may experience losses in the stock market, real estate, and other investments. Additionally, industries that employ high-income workers, such as finance, technology, and professional services, can be significantly impacted by recessions. The effects of recessions on different income groups can also vary depending on the nature of the economic downturn and the specific sectors affected. It's important to recognize that recessions can create financial challenges for a wide range of individuals and households. Part 7. Preparing for the future. Myth 15. You can't prepare for a recession. Fact. While predicting the exact timing of a recession is challenging, you can take steps to mitigate its impact. Diversifying investments, maintaining an emergency fund, and continuously updating your skills can help you weather economic downturns. According to a survey by Bankrate, 39% of Americans had enough savings to cover a $1,000 emergency in 2021, highlighting the importance of financial preparedness. Building a robust financial plan that includes saving for emergencies, reducing high-interest debt, and investing in a diversified portfolio can provide a cushion during economic downturns. Regularly reviewing and adjusting your financial plan can help you stay on track and adapt to changing economic conditions. Additionally, staying informed about economic trends and potential risks can help you make proactive decisions to protect your financial well-being. Continuously updating your skills and seeking opportunities for professional development can also enhance your resilience and employability during recessions. Myth 16. Recessions are a modern phenomenon. Fact. Recessions have been occurring for centuries, often driven by different factors. The Panic of 1873, the Great Depression of the 1930s, and the more recent recessions all had unique causes and impacts. Studying historical recessions can provide valuable insights into how to navigate future economic challenges. Historical recessions have been triggered by a variety of factors, including financial panics, banking crises, commodity price shocks, and geopolitical events. For example, the Panic of 1873 was caused by a combination of railroad overbuilding, speculative investments, and the collapse of the banking sector. The Great Depression was precipitated by the stock market crash of 1929, combined with structural weaknesses in the economy and policy failures. By studying past recessions, we can learn about the factors that contribute to economic downturns and the effectiveness of different policy responses. This knowledge can inform our understanding of contemporary recessions and help policymakers and individuals make more informed decisions. Finally, we've busted some of the most pervasive myths about recessions today. Understanding the true nature of recessions, their causes, and their impacts can empower you to make informed decisions and better prepare for economic uncertainties. Remember, knowledge is power, and being equipped with accurate information is your best defense against the fear and uncertainty that recessions can bring. If you found this video insightful, don't forget to like, share, and subscribe to Insights and Head Beyond. Let us know in the comments what topics you'd like us to explore next. Stay informed and stay resilient. Thanks for watching. Keep exploring, keep questioning, and we'll see you in the next video.